What if I told you my portfolio pays me every single 9 days? Not once a month, not once a quarter. Every 9 days. That's about 40 paydays a year without a boss, without a commute, and without pretending to care about the office birthday cake for someone you've never spoken to. And no, this isn't crypto, it's not options trading, and it definitely doesn't involve a Discord group called Passive Income Kings. This is a boring, old-school, grandma-approved dividend strategy using some of the largest companies in the United States. And here's why this matters right now. U.S. dividend payouts are expected to reach roughly $830 billion in 2026, growing around 6.5% year over year, which means the total cash being paid to investors is literally increasing. That's not hype. That's companies wiring money to shareholders. In this video, I'm going to show you how the every 9 days system actually works, the types of stocks that make it possible, the real income math behind it, and the mistakes that will absolutely nuke this strategy if you're not careful. I'm Jack, and I take confusing money stuff, translate it into real-life game plans, and keep it about as exciting as finance can legally be. And if you like the idea of getting paid while napping on the sofa, hit the like button and subscribe. Here it's all about growing genuine wealth through proven strategy. No fluff, no gimmicks. Part 1. The problem with normal dividends. Most U.S. companies pay dividends quarterly, which means you get paid 4 times a year and spend the other 11 weeks and 6 days wondering if your portfolio forgot you exist. You buy a stock, you wait 3 months, you get a payment, and by then you've already forgotten which company paid you and spent the money on coffee. Quarterly dividends are great for long-term wealth, but they're terrible for anyone who wants consistent cash flow. It feels like having a job that only runs payroll once every 90 days and HR keeps saying, "Don't worry, it's coming." So income investors started asking a simple question: can I get paid more often? The answer is yes, but not by finding a magical stock that pays every week. You do it by stacking the calendar. Part 2. The 9-day dividend system. Here's the trick. You don't need one company that pays every 9 days. You need multiple companies that pay on different schedules, so the payments fill the gaps. When you own stocks that pay in different months and on different dates, the income spreads out. Instead of getting one big lump of cash 4 times a year, you get smaller deposits, constantly showing up in your account. And this isn't theoretical. In a single month, there can be thousands of dividend payments across the U.S. market, with some days having hundreds of companies paying shareholders. That means if you own enough of them and they're staggered properly, you can create a stream where money lands in your account every week, sometimes every few days. That's the entire 9-day concept. It sounds fancy, but it's really just calendar management and patience. Part 3. The types of stocks that make this work. To make this system function, you need a mix of different dividend types because relying on one category either makes the income unstable or too slow. Monthly dividend stocks form the backbone because they give you 12 payments a year by themselves. There are now more than 100 monthly paying securities available, many of them in real estate and business development companies, and some of them yield between 5 and 10%. Companies like Realty Income have built their entire brand around paying investors monthly, which is the closest thing the stock market has to a salary. But monthly payers alone aren't enough because many of them are in the same sectors, and that creates risk. That's where the quarterly dividend giants come in. These are the Coca-Colas, the Procter & Gamble's, the Johnson & Johnson's of the world, the companies that have been paying and raising dividends for decades. There are currently 57 dividend kings, meaning they've increased their payouts for over 50 consecutive years, which is longer than most gym memberships last. They don't always have the highest yields, usually sitting somewhere between 2 and 4%. But they bring stability. They're the reason your income keeps coming, even when the market is having a meltdown. Then you add a layer of higher yield sectors like energy, utilities, financials, and certain REITs. Financial stocks alone average a yield above 4%, which is higher than most sectors in the S&P 500. Some energy partnerships pay around 8% and still grow their payouts. These boost your cash flow, but they're the spicy part of the portfolio. You don't build the whole strategy on spicy. Part 4. The actual income math. Let's talk numbers without making this feel like a math class. If you had a $100,000 portfolio with an average yield of 4%, you'd generate about $4,000 a year, which works out to roughly $333 a month. Now here's where the calendar strategy changes the experience. Instead of getting $1,000 every 3 months and forgetting it exists, that same money shows up in smaller deposits throughout the month. One week you get paid by a REIT, the next week by a consumer staples company, the week after that by an energy firm. It's the same total income, but psychologically it feels completely different because the payments are constant. It turns investing from something abstract into something tangible. Suddenly you're looking at your brokerage account and thinking, nice, my toothpaste stock just bought me lunch. Part 5. Why this strategy is blowing up right now. Dividend investing is having a moment. For years, growth stocks dominated the conversation, but now income is back in style. As interest rates shift and investors look for cash flow, dividend stocks have started outperforming expectations. Analysts expect payouts to keep growing, and we're even seeing big tech join the dividend club. Meta and Alphabet both initiated dividends recently, adding billions to total US payouts. When companies that used to say, "We don't pay dividends because we're focused on growth," suddenly start paying dividends, that's a cultural shift. It means cash flow matters again. Part 6. The compounding cheat code. Here's where this gets powerful. Frequent dividends allow faster reinvestment. If you're getting paid every few weeks instead of every few months, that cash gets redeployed sooner, which means you're buying more shares earlier, which means those shares start paying dividends sooner. It's a feedback loop. More shares lead to more dividends, which buy more shares, which lead to more dividends. It's a snowball, and it's not a fast snowball, but it's a very loyal one. Part 7. The biggest mistakes people make. The first mistake is chasing yield like it's a Black Friday sale. If you see a 15% dividend yield, that's not a gift, that's a warning label. Some mortgage rates can yield over 14%, but they're extremely sensitive to interest rates, which means the income can disappear faster than your motivation in January. The second mistake is ignoring dividend safety. If a company is paying out more than it earns, the dividend is living on borrowed time. High payout ratios look great until the cut happens, and then suddenly your passive income becomes passively disappointed. The third mistake is lack of diversification. If your entire portfolio is in one sector, your income will swing with that sector. Mixing different industries and payment schedules is what smooths the cash flow and keeps the calendar full. Part 8. How many stocks you actually need. People always want a magic number. In reality, creating near weekly income usually means holding somewhere between 20 and 40 dividend positions across different sectors with staggered pay dates. That sounds like a lot until you realize you're building a long-term income machine, not a 3-stock TikTok portfolio. And yes, it takes time to build. This is not a turn $500 into $5,000 a month strategy. This is a years-long system that eventually runs on its own. Part 9. Who this strategy is for. This works best for long-term investors who want passive income and don't mind being patient. It's ideal for people planning early retirement, people who like cash flow, and anyone who's tired of waiting 3 months for a tiny payment. It's not for day traders, adrenaline junkies, or people who check their portfolio every 10 minutes and panic when a stock moves down 1%. This strategy rewards patience, not excitement. Part 10. The psychological benefit. This is the underrated part. Frequent dividends change your behavior. When the market drops and prices fall, your income often stays the same, which makes downturns easier to handle. Dividend growth stocks have historically been less volatile during sell-offs, and that stability keeps you invested. Instead of seeing a red portfolio and panicking, you see new dividends buying more shares at lower prices. That mindset shift is powerful because it turns market volatility into something useful. Part 11. Realistic expectations. Let's be honest, you're not quitting your job next month. At a 4% yield, $25,000 generates about $1,000 a year, $100,000 generates about $4,000, and $500,000 generates around $20,000. It takes capital and time, but the goal is income growth. Many dividend portfolios see their income increase every year because companies raise payouts, and reinvested dividends buy more shares. It's like getting a raise without asking your boss, which is the best kind of raise. Part 12. The Simple Build Plan. If I were starting from scratch, I'd begin with stable dividend growers for reliability, add monthly payers for frequency, then layer in selective higher yield positions for income, reinvest everything, and track the dividend calendar. No options, no leverage, no hype, just consistent cash flow. Bring it full circle. So no, I don't own a stock that pays every 9 days. I own a system that does. And that system turns the stock market from a scoreboard of prices into a machine that pays you constantly. It's slow, it's boring, and it's incredibly effective. While everyone else is chasing the next 10x crypto, I'm getting paid by soda, oil, and toothpaste. If you want more videos breaking down real income strategies that actually produce cash flow, hit like, subscribe, and I'll see you in the next one. And remember, your portfolio shouldn't just grow, it should pay you.